Hi everyone, my name's Randy Bruns. This report that we're going to talk about today is the Mutual Fund Landscape Report. This is the 2023 version of it. It's produced by Dimensional Fund Advisors, also known as DFA. It basically looks at the historical performance of US-domiciled mutual funds. It looks at survivorship of all the different funds. It looks at persistency of past performance, and then it also includes factors like expense ratios and turnover ratios and shows their effects, historically speaking, on performance. So I'm going to let's shrink myself a little bit down here. We'll put me up here. And so let's just look at the mutual fund universe as for U.S. domiciled funds as of December 31st, 2022. There were 4,719 mutual funds in existence at the end of 2022. 1,581 of those were fixed income or bond funds. 1,136 of them were international stock funds, and 2,002 of them were U.S. stock mutual funds. Now, mutual funds hold assets. If we want to see how much assets were held inside of all those funds, it was actually $9.4 trillion. 2.9 trillion was invested in the U.S. bond market in terms of mutual funds. 1.9 trillion was invested in international stock mutual funds, and 4.6 trillion was invested in U.S. stock mutual funds. Let's look at the performance, though, of all these funds. So if we just focus on U.S. domiciled mutual funds, this data, again, is as of December 31st, 2022. And I'm going to focus on the 20-year period down here. 20 years ago, 2022 was January 1st, 2003. If you were looking at the universe of mutual funds, U.S. stock mutual funds that you could have invested in, you had 2,855 different choices. 20 years later, though, just 44% of those have stayed in existence. The other 56% don't exist anymore. They were closed. The assets were merged into other funds. And why is that? I would suspect that it's because less than 2 out of 10, or 17% of those 2,855 funds managed to outperform the very same benchmark index that they were measured against. So, and your thought might be, well, shouldn't I own more funds? Wouldn't that increase the likelihood that I get one of those 17%? Yes, it does, but also what's going to happen is you're just increasing the odds that these statistics are going to work against you, basically. And then we can look at the bond market. Similar data 20 years ago. So back on January 1st, 2003, you had 1,636 U.S. bond funds to choose from. Just 49% of those are still in existence. And the data for outperformance, just 14% of all U.S. domiciled bond funds managed to outperform the benchmark index that they were measured against. So if you ever hear anyone say, just own passively managed index funds, this data is likely what they are referring to, or this data is something they would use to justify their argument. If we look at maybe past performance is how you can find winners, it's not true at all according to research, because if you look here, this is at any given point in time. These are all the funds out there, and then this table on the left, this illustration on the left, just basically says, well, what if at any point in time you chose the top 25% of the past 5 years performers, and you can't get a 5-year number until looking back to 2003 until 2008. So if you did that in 2008, just chose the prior top 25% from the prior 5-year period, 5 years after that, just 16% of those funds remained in the top 25%. If you did it in 2009 and looked 5 years later, just 14% of those remained in the top 25%. If you did it from 2008 all the way to 2018 would give you the 5-year period ending 2022. On average, just 22% of those prior winning funds remained winners looking forward. If we did that for the bond market, same data here. If you did that in 2008, 5 years later, just 34% of those funds remained in the top 25%. if you did it in 2009, just 6% of those funds remained in the top 25%. And then you do it in 2018, which would take you to 2022, just 31% of those funds remained in the top 25%. Over the entire period studied, just 32% of past winners remained winners in the subsequent 5-year period. One of the biggest reasons is cost. So this basically, we're going to stick with the 20-year period here. If we look in terms of a fund's expense ratio, makes some sense that we would look in terms of an expense ratio, because if we're trying to outperform a benchmark index, well, we first have to outperform the expenses of the fund to just get on pace with the index, and then outperformance begins after that hurdle. If we look at the 20-year period, what the Mutual Fund Landscape Report did is they separate the funds into 4 quartiles for expenses from lowest all the way to highest. And then over here, you'll see the median expense ratio for each of those quartiles. The lowest expense mutual funds had a median expense of 0.83%. The highest expense quartile had a median expense ratio of 1.72%. But even the lowest cost funds, 29% of them, which is a pretty small number, 29% managed to outperform their benchmark index. Still a lot better than the outperformance of the highest expense mutual funds, where it came in as just 6, basically. If we look at that for the bond market, similar quartile, or the same quartile, 4 quartiles, slightly lower expense ratios, because bond funds tend to be lower expense than stock mutual funds. The lowest quartile had a median expense ratio of 0.51. The highest quartile of bond fund expenses was 1.03. But still, you see a little bit of more outperformance for the lower expense ratio funds than the higher expense ratio funds, albeit it's a 20% of those funds outperformed versus 9. So we're seeing some data that supports lower cost funds than higher cost funds. Another cost, though, is a fund's turnover ratio. In other words, how frequently does a mutual fund change its holdings, basically, or turn over its holdings? If we look at the 20-year data for U.S. stock funds, the median turnover, again, 4 quartiles here. So the lowest quartile had a median turnover rate of 26. The highest quartile turnover was 130. We can look here that just 30% of the lowest turnover funds managed to outperform the index over the past 20 years, and the highest turnover funds, only 10% of those managed to outperform the index. So some takeaways from this is outperforming funds were in the minority. Strong track records failed to persist, and that's not hard to believe when every mutual fund disclosure says past performance is not indicative of future results. High costs, in other words, expense ratios, excessive turnover rates may have contributed to underperformance. The lessons that you can take away from this is markets effectively aggregate investor knowledge and expectations into prices that are reliable. Managers attempting to outguess market prices may incur higher costs that raise the barrier to outperforming an index. Successful investing involves more than just picking a top-performing fund from the past. And you should always consider a fund's investment philosophy, robustness in portfolio design, and attention to costs, among other factors. This is exactly how we design mutual fund or investment portfolios at Model Wealth. That's basically how things go around here. And that's how any good financial planner should design a portfolio for you. If you have any questions, feel free to reach out. Otherwise, we hope you enjoyed this video.